Hi, this is Joe Rabel with Invest Like a Pro. I wanted to follow up on the video about good weakness versus bad weakness and give a little bit more detail as to how I would really look at that. And I wanted to point out one of my favorite patterns to look for when I'm using the 2 time frame approach. I am currently looking at Cisco on a weekly chart. It goes back about 3 or 4 years. I want to make sure that you have a better understanding of what good weakness is to me. And if you start looking at things this way, you're going to find really good buy areas. And then because really it's about stock selection. I know timing is important, but in terms of figuring out which are the right names to own and which ones to focus your efforts on, you want to start with the higher time frame. In this case, I'm going to show you some what I would consider to be almost a breakdown or a pretty harsh sell-off on the lower time frame. And if you're not using multiple time frames, you're going to get either sucked out of a stock, like you'll sell a stock at the wrong time, or I think you'll miss an opportunity that presents itself. I'm a fan of buying weakness. I mean, I don't want to give you the impression that I want to buy a big reversal or a lot of strength. I'd rather you look for areas that are high probability support areas. So let's just get into this chart. I think it'll make a lot more sense. I'm going to start in this period here in 2017. And if you notice, the stock hit a new high and then it goes through a correction period. And I'm just going to point out here. So this spot on this chart where you made a low and then you consolidated for a while. And then look at this. It takes out this big bar to the downside. I mean, that looks if I'm looking at this in a single time frame, I'm looking at this big bar down and how it consolidated. All these bars up until this red bar here stayed inside this big, huge bar. I mean, that's pretty negative action. So again, if I'm just looking at it in a single time frame, I'm looking at this whole pattern thinking, wow, this could easily be followed through to the downside. So let me just circle this spot on the chart. And then, so that's one area. And then the second area I want to look at is here's the stock going through a consolidation. It holds the 40-week, rallies up to a new high, comes down, makes a lower peak and a lower low, and then undercuts this bottom. So let's just highlight this here. Clearly makes a new bottom versus that low. Now, again, look at the violent bar down. You're taking out the 40-week for the first time in a while. You're taking out the prior low that had been pretty good support. That's at this point here. So let me just highlight this point. So these are two areas where if I'm looking at a single time frame, if I'm just looking at this on a weekly chart, I would think that the average person, most people that are looking at this would be somewhat disturbed by this price action here and this price action here as it's taking out these prior areas. I'm going to just move this over so we can see what's taking place on the higher time frame. Let me just zoom in a little bit so you can still see the bars. So now I've got the monthly chart on the left and the weekly on the right. This is what we were looking at before. The undercut here, undercut here. So I refer to this pattern where you come to a prior low and break it and have no follow through in a somewhat of a key area and then reverse. I would call that an undercut and rally. I mean, I didn't invent that phrase, but it's something that I've kind of adopted and listening to other people. But the idea here is you're breaking in kind of a key area, and instead of following through to the downside, you immediately reverse. And what happens is you suck people out of the trade, and you have I think it creates a sort of a built-up demand automatically. And it can get very violent in the opposite direction when this turns. So this is the type of weakness. I mean, if you want to buy violent weakness, you want something that's almost like gapping down or has very violent price action to the downside, This is the type of thing you want to be looking for. You undercut a prior low and you do it, in this case, let me just make this circle a little bigger so you can see that it is right at this monthly. It's right at the 18-month MA. So I know when I look at the monthly chart that, and let me just make this a little bigger so you can see that this is, again, so that didn't actually work very well. I'll make that. So we're coming in two specific areas to the 18-month line. But on a weekly chart, you're taking out a prior low and you're undercutting that in a somewhat of a violent fashion. These are the opportunities that I think where if you want to buy weakness and you want to be more of an aggressive buyer when a stock is down, this is the type of thing you want to be looking for. Especially because if I go and look at the MACD on a monthly chart, you hit a new high with price here. And then on this peak, you made a new high. In this case, it was a pinch play as well. But more importantly, and I think that one of the key factors is you have a rising 18-month line, just like we discussed in the good weakness versus bad weakness video. But in addition to that, it's rising and you're coming into the pullback is coming right into this area. Now, I mean, I can go to another level and say, okay, I've got really good price support from here. That's major price support you're coming into on that level. And so that area did create, there were several factors that were telling me this was a high probability buy point. But I wanted to just point out that this undercut and rally pattern that takes place on the lower time frame is really something you want to be on the lookout for. If you want to be more of the aggressive style of buyer, where you want to buy when something's down, it can be a very attractive and really, you're going to get your risk reward on these trades are really outstanding. The other factor that I would say is, let's just look at one other thing on this, especially on this second signal. It kind of happened in both. In this case, the MACD was confirming the failure setup. This is a sell signal that fails where the 18 crossed below the 40. You kind of came in the zone and then just broke out above. And the MACD cross above is confirming the break above the 40 week. In this case, you had sort of a deep drop. You don't have this pattern, this failure pattern really. They're starting to come together here. But really, when this is down and low, you need to rely a little bit more on this MACD. And if you notice, it's come from a long way. I mean, this was way overbought up in here. You came down, you made a lower peak, and then look at where it starts to turn, right at the 0 line. And in this case, I would have probably been relying on the price action instead of getting a pattern of like a failure setup or a 40 to 18 bounce, or a 1, 2, 3 change in trend. In this case, I would have said, you know what? I know I'm in a really high probability area in terms of 18-month support. I've come down violently and gotten pretty oversold. I've got the MACD turning here. I've undercut. And look at the bars. I got a big tail forming here and another big tail forming here. I'm going to start to get a little bit more on the aggressive side in this type of a situation. And I might just wait for, those two high tails to be taken out and be more of an aggressive buyer in this instance because of what has built up with the longer term support, the undercut pattern, the support from the MACD's 0 line. All of these are factors that I think can help you be a little bit more aggressive. I just wanted to give you a little bit better example of how I would look to buy or what I would consider to be buying into good weakness. So hope this was helpful and clears up any questions you might have had. Please subscribe below. We'll talk to you soon.